Welcome to 3 and 3. Today we're going to be talking about yields, specifically the 10-year Treasury yield versus the S&P earnings yield, market breadth expanding, and free cash flow. So the S&P earnings yield is a ratio that indicates the relationship between a company's earnings and its stock price. It can be helpful when a concern is about a stock's rate of return going forward. If we have a low earnings yield, typically that stock is quite expensive. Especially when comparing the 10-year Treasury with the S&P earnings yield, it can be a good starting point when assessing where to allocate money. Do you put money in stocks or do you put money in bonds? Currently, the yield on the 10-year Treasury has surpassed the earnings yield on equities for the first time in 14 years. Higher Treasury yields could now make them more competitive with stocks for future dollars. And we cautioned about this in our March update about potentially being at an inflection point as the price-to-earnings ratio on the S&P was over 21 and 10-year Treasury yields were climbing. As you can see from this chart, the purple line is the S&P earnings yield, and the orange is actually the 10-year Treasury. And that actually 10-year Treasury now has surpassed the earnings yield of the S&P. Market breadth expanding. So market breadth can simply be defined as how many stocks are advancing versus declining within an index, a sector, or group over the overall market. Many investors associate breadth with the health of the overall market as it highlights what is going on underneath the surface of the index level. At the end of March, 86% of S&P stocks closed above their 200-day moving average, the highest reading since 2021. And as you look back in history, we've had that many stocks actually passing their 200-day moving average. It's actually quite positive for the market going forward. Free cash flow. Free cash flow is the cash remaining after a company has paid expenses, interest, taxes, and long-term investments. Free cash flow can be used to buy back stock, pay dividends, or participate in mergers and acquisitions. Historically, companies with high free cash flow actually do better than companies with lower free cash flow over time. As you can see from this chart, going back to 1991 to 2021, and you're looking at companies that have higher free cash flow, looking at the Russell 1000 index, the performance has actually been quite considerably higher over that period of time. Thank you for joining us for 3 and 3.